Hi everyone. Today I am talking about the advanced accounting and financial management, some small parts regarding the cost of capital, minimum rate of the return, cost of debit, and market value weights. Okay, let's see this video content. First one is the cost of capital. Second one is importance of the cost of capital. Third one is key justification for the use of cost of capital. Fourth one is minimum rate of return. Fifth one is the relationship cost of capital and weighted average cost of capital. Next one is cost of debit, and final one is market value weight. Now I am talking about the valuable topic in this video. This is the cost of capital. The minimum rate of the return a company must be generated on its investment in order to appease investors, that means lenders and shareholders, and perceive its market value is known as the cost of capital. In addition, it serves as the barrier rates of the asset in new projects and shows the cost of using funds from the loan and equity. Considering about the lenders, it can be a traditional banks, credit unions, online lenders, peer-to-peer platforms, and specialist lenders. When we take the decision, IRR is the larger than minimum rate of the return, the project is accepted. If not, IRR is smaller than the minimum rate of the return, project will be rejected. Now I am talking about the importance of the cost of capital. The first importance is investment decision, which means project with returns higher than the cost of capital creative value, otherwise they destroy value. Okay. Then second important is capital structure, which means help the firms determine the ideal mix of the debit and equity to minimize the overall cost of funding. And third one is valuation, which means use the discount rate of in the discount cash flow, that we are talking about DCF, analyzed to determine the present value of the future cash flow. Mention about the key justification of this cost of capital. It is good for us. So first one is the investment hurdle rate, which means a project with an internal rate of return, that means IRR, lower than the WACC are typically rejected or destroy the value. Okay. Then second one is the valuation. That means the WACC is the standard discount rate for the DCF, that means discount cash flow, models to determine the present value of the future cash flow. The third one is optimal financial mix, which helps the companies identify the lowest cost of the balance of the debit and equity to minimize the shareholders' value. The last one is risk evaluation. Higher risk project, that's mean higher beta, assign higher cost of the capital to compensate for the potential losses. Now I am talking about another important topic, which means weighted average cost of capital. I keep here that formula also, which means a company average cost of financing from the debit and equity weighted by the market value. So represented as the weighted average cost of capital. Cost of capital, that means WACC. Now I am going to find about the relationship cost of capital and weighted average cost of capital. Which is very important when we are doing the projects. Here I am again keep that formula also. You can see the E multiplied by the RE and that formula include equity. Other part is you can see the D multiplied by the RD. That part is the normally we think about the debit part. Yes, valuable things is the equity equal asset minus liabilities. Considering about this formula, this main standardized technique for determining the business total cost of capital is weighted average of cost of capital, which represent the combined proportionate cost of debit and equity financing. WACC is the discount rate of use value future cash and minimum return of the investment. When we are doing projects, WACC assumption is very important, because if not, we are very difficult to calculate part. Mainly I am using four assumption I use here. The first one is constant capital structure. WACC assume the ratio of the debt and equity remains stable over the project or valuation life, despite potential real world fluctuation is financial. The second one is value of the weights. Second one is market value weights. That means assumes using the market value of depth of equity, not book value, to reflect the current investor expectation, because it is very important this assumption for the shareholders. The third one is constant risk profile, which means a company business is financial risk assumed to stay the constant, meaning the project being evaluated as the similar risk to the overall business. The last one is the tax deductibility of the debit. Normally we call tax shield. It assumes the interest payments on the debit are fully tax deductible tax shield, which lowers of the cost of debit. Now I am going to find about the justification of above assumption, because it is very important to us. Here I keep four justification. Why market value? Now I am going to find about the justification of above assumption, because it is very important to us. Here I keep four justification. Why market value? Second one is why after tax debit. Third one is why a weight of average. Why constant capital structure. The first one is the why market value, which means book values are historical and often derived from the current economic reality. Using market value for the debit and equity ensure the cost of capital reflect what the investor require today and provides funds, because investors always looking of the today, not past. Then second one is why after tax debit. Interest on the debit is treated as a business expenses, since expenses reduce taxable profit. The company pays less tax to the government. That time companies pay the less taxes for the government. The third one is a buyer weighted average, which means companies really fund the project with 100% equity or 100% debit. A weight average of correctly reflects to the breadth of the financing, which is shows weight by the its contribution of the total capital, because we have never seen like such a 100% equity or 100% debit companies. Then last one is why considered capital structure. Why the this means the while capital structure change using the target to average ratio of necessary for the stable discount rate of the long time valuation model like NPV. I will mention later that one, which become the easier and more reliable. Before all topics for I use justification for that assumption. This time I use the justification assumptions for this cost of debt also. The first one is the use of the YTM, which meaning is the prepared over the coupon rates because it's reflect the current market cost to raise the debit. Accounted for the changes in the interest rate and the company's credit risk since the debit was issued. The second one is the after tax calculation, which means the interest payments reduce the taxable income, which lower the company's tax bill. This tax saving reduces the real cost of the debit, therefore the bank uses the after-tax cost. Now I am going to talk about the market value of the weights. This is the last part of my video. The market value weights mean is market value represent the proportion of the firm's capital structure based on the current market price on its securities and then historical book values. The weight represents the market value weights of the each components, not the book values. Now we shall consider about the if book value is used, what happened to our business? Because all historical data bias and capital structure also inaccurate and misleading also back. Then if we use market value, what happened to our business or our budget? That means a real-time capital structure reflect. Investors actually require the return of the capital more accurate our valuation. Okay, then I'll go last part of my video. This is last part of my video. Here I am considering about the assumptions and justification of the market value weights. First we look at the assumptions. The first one is current capital structure is optimal. Okay, let's see that one. This means efficient market company will try to maintain current equity ratio. Any deviations are temporary and long-term financing policies stay stable. The second one is the efficient markets. It is assumed that market price of the equity and debit reflect the present value of the whole expected future cash flow and accurate reflect the risk. The third one is future financing proposals. It is assumed the firm will raise new capital for the projects in the same proportion as its current market value capital structures. Fourth one is equivalence to the opportunity cost. Equivalence to the opportunity cost means that weight should be reflect the real economic value of financing. Equity must be measurable at the market value because it reflects the investor expectation and opportunity cost. The depth is often close to its book value, so it can sometimes to approximate, but equity must always reflect the market value for the accuracy. Okay, then I am go about the justification. This is the first one, economic reality, which means market value reflect the current price investors are willing to pay, offering the better indication of the value than historical accounting figures. Also, we are mentioned about that. Then second one is consistency of the component cost. Component cost of equity, cost of debit, cost of debt are determined by the market rates. So weight of should always market determine. The last one is accurate hurdle rate, which means back calculated with the market rate give the accurate hurdle rates for the investment appraisals, ensuring the investment makes sense for the current investors. Okay, this is the last part of my video. I think I try to my maximum weight of to explain this contents. So I wish you all the best and good day.